I think there is now an overwhelmingly preponderant body of evidence suggesting that the economy is currently in recession and will be so judged by the NBER Dating Committee. If one looks at the monthly indicators on which it relies, employment, personal income, industrial production, the level of real retail and wholesale sales, they are all suggesting that we are currently in recession. The question for forecasters and, more importantly, for policy now is how serious and how prolonged that recession will be. My judgment has been less optimistic than the consensus for quite some time, and I continue to be seriously concerned about the economy's prospects. In essence, what is happening to the economy now is the simultaneous operation of three troubling vicious cycles that are mutually reinforcing. The first, which one might refer to as the liquidation vicious cycle, is the process where the law of demand works in opposite directions. Normally in economics, when the price of something falls, the demand for it increases. In the world of many securities today, which are held on margin or are held by entities with scarce capital, when their price falls, there is pressure to sell them, and so the demand for them falls. And when you have a situation where falling prices lead to falling demand, you have a vicious cycle in the making with falling prices, falling demand, further falling prices, and so forth. Second, you have the Keynesian mechanism characteristic of all economic downturns, in which reduced spending leads to reduced incomes, leads to reduced spending, and the cycle continues. Third, and less conventionally, you have in the current context what economists label the credit accelerator vicious cycle mechanism, reflecting the reality that a weakening economy leads to lower profits, reduced ability to service debts, leads to increased financial distress, which leads to less lending and a weaker economy, which leads to still further financial distress. All three of these mechanisms are now operating with substantial virulence in the U.S. economy. This is very rare. In 1987 or in 1998, in the LTCM period, the mechanism involving liquidation was operating at very substantial virulence, but because the underlying economic fundamentals were strong, there was not nearly the same force in the other mechanisms. In previous recessions, there was the Keynesian recession mechanism operative, but there was not the large-scale reliance of the economy on securitized finance that made the liquidation mechanism a major aspect of the situation. To that extent, we are in uncharted and troubling territory with, in my judgment, a very real risk of the most serious economic downturn in a generation, by which I mean an economic downturn more serious than that in 2000 or than that in 1990. At the center of the operation of all three of these mechanisms is the question of the capacity of the financial system to intermediate capital and to provide lending. The events of recent weeks suggest an increasing risk that the principal policy tool on which we have relied, Federal Reserve lending in one form or another to banks, has the character of fighting a virus with antibiotics. It is not addressed to the central constraining element. The central constraining element increasingly appears to be that intermediaries with scarce capital have a desire to reduce the size of their balance sheets and in any event can support only so much lending. If that is the case, making available loans to them on ever more attractive terms will not lead to an increase in their lending capacity, therefore will not lead to increased support for asset prices, and will be availing only at the margin, in the same way that antibiotics with respect to a serious viral infection can be constructive in treating some opportunistic infections, but do not address the core of the problem. In my judgment, ultimate success here is likely to require that voluntarily or involuntarily, privately or publicly, means be found to infuse significant increases in capital into the nation's financial intermediaries so that they are enabled to increase the volume of their activities while remaining creditworthy so as to permit a resolution of these difficulties. I would note in this regard that the traditional emphasis on capital ratios, as important as it is, looks past a crucial aspect of the current situation, namely that an institution under pressure to reduce leverage can do so in two ways: by reducing the size of its balance sheet or by increasing the size of its assets. If its shareholders are indifferent between those two at some point, because increasing equity leads to dilution and a reduction in the value of existing shareholders, the nation is not. Adjustments achieved through increased capital may be less appropriate and less desirable for shareholders, but are much more desirable for the national economy. For this reason, it is my strong suspicion that sufficient levels of capital will not be attained simply by relying on voluntary private action in pursuit of individual shareholder interest. There is the real possibility of a fourth vicious cycle mechanism to compound the three that I spoke of, and that is falling housing prices leading to increased foreclosures, leading to an increased number of houses on the market, leading to a larger supply of housing, leading to further declines in housing. Whether this mechanism is currently operative or not seems to me very much in doubt. It is far from clear that at current prices, the housing market downturn has overshot what is necessary for a return to fundamentals. In any event, housing prices are currently down 10%, and the best available market forecasts suggest that they are likely, on average nationwide, to decline another 15%. At these levels, it is likely that as many as 15 million homes will have negative equity, and projected foreclosures, though there is not great deal of historical experience with which to base judgments about foreclosures in the presence of negative equity, are certainly in the 2 to 3 million range, and perhaps more. Policymakers and other advocates, including some of those on our panel this morning have rightly focused on a critical insight, namely that the foreclosure process itself is enormously expensive. In many cases, the act of foreclosing on a home, once all the transactions costs, the costs of the disorderly liquidation are taken account of, can absorb as much as 40% or more of the value of that home. And so it is natural to seek to find ways to minimize the number of foreclosures, to reduce the risks of the fourth vicious cycle mechanism that I described, and in any event, to alleviate the very real distress that concentrated foreclosures in particular communities may bring about. It is not clear to me that any approach to the foreclosure problem is sufficient to address the economic concerns that we are facing. It does seem, however, that finding constructive approaches to the housing market is necessary if we are to avoid a great deal of collateral damage, human suffering, as well as economic risk from the current housing downturn.